Welcome, guys. It's the Market Sniper. Glad to be back with you. Interesting takes on our friend Kai Hoffman, who has Saw financially, and chat you had with Michael Oliver. I want to overlay an opinion and some diagrams we've done on top of this. And let me be clear, if I do run with the heading, it's the debt stupid. The word stupid is not in reference to either of these two people who are running a great channel as a host and Michael as guest. They're both smart. It's more about the cachet of that original Bill Clinton statement. It's the economy stupid that allegedly won him the election at the expense of George Bush Sr. So I want to talk about rates and Fed action versus gold price, because there's a lot of misconstrued theses that gold can only go down on rate cuts because it doesn't pay a yield, and therefore the differential between its zero yield and what you're getting on a debt instrument that has diminishing yields because of the rate cut means gold becomes better value. That's a bit of a misnomer, and I want to deal with this. Let's listen to the question as it's put by Kai to Michael, and then I'll overlay my take after we've let them say their piece.
Start with the correlation between the Fed and the Fed funds rate and gold. I'm curious about that. You touched on the Fed briefly here. Do you see a correlation into the statements made by Chairman Powell and the gold price, how it's reacting, or am I just imagining things here?
I don't think it does. There's many times where the Fed will be at a rate increase and gold will go up. Go back and look at the mid-70s, 74, 75. Late 70s, 78, 79, and 80. Gold exploded, and yet they were raising rates the whole time. Okay, the Fed is a primary generator of the boom-bust cycle. The boom-bust cycle we see in stocks, they create boom-bust cycles in monetary policy, which has real-world effects, not just the stock market, but in everyday lives of people and the cost of goods and so forth. They don't mind inflation in the stock market, but they mind it, they say, when it's commodities and it causes people to be painful when they go to the grocery store. But Powell has made it very clear.
So the question is around, but the Fed is doing XYZ on rates. How much is that going to lean on the gold price? And that depends very much on the environment you are in at any point. So the key element with any question, and I'm almost going to make this a new standard in terms of any appearances I make. I'm going to ask all hosts to repeat after me. It's the debt stupid. And I'm going to tell them to tell me that as well, and I'll nod. Even if I ask them what's my name, I want them to say, it's the debt stupid. Because this point really needs to come through. The debt markets are too big, too large, growing too hyperbolically fast, and as a result, they are contracting in value. In fact, the guest Michael Oliver quite correctly referenced the mid-late 70s as a key thing, and that coincided with the Vietnam War that officially started being seeded in 64, ran through the second half of the 60s, ran into the beginning of the 70s. 71 Nixon, after the rest of the world said, hey, America, blanket bombing jungles, that sounds productive. Seems like you're blowing a whole bunch of money with the military industrial complex and taking bungs and doing all the usual corruption and spending a lot of money. We think rather than holding your paper, we'll ask for that convertibility, the gold, instead. In short, when confidence in paper dies, people go to gold. Let's just repeat that after me. When confidence in paper, the fiat dollar, disappears, the French and then the other central bank heads of Europe asked for the gold that was backing it that America held and sent ships into New York Harbor to get it loaded up. Don't worry, we'll pay. Just get it ready there. We'll come and collect it. Okay? That's how it went down. And that is because of excess spending based on issuance to fight a war in the military-industrial complex. It was an unpopular war with most of the people. They didn't understand why they're doing. No, we're fighting communism. Meanwhile, the communists were all at home. But never mind, that's a separate geopolitical instance. You ended up having a McCarthy era, etc., etc. What is happening when debt devalues? Well, we brought up a couple of our diagrams before. I know I've shown you the ones where I have the seesaw, and I thought I would show it to you again, but I think you all remember that. Debt valuations going down, the rates have to go up. when debt valuations go down, rates have to go up. And here's kind of where we're at in terms of our system. We are in a legacy system of fiat and debt that is deflating. And the more it deflates, so we started here with a huge Jupiter ball of debt that is made up of fiat currencies borrowed into existence. And every time there is an over expenditure by the likes of Yellen, who's probably still serving until Trump's officially been put as president in January, you have excess money creation. And the way they do that is they issue new debt. The whole time the US government is issuing new debt instruments that other people have to buy. Sometimes the Fed itself buys them. The primary dealers, if they can't sell them, they have to sit with them. So that's Goldman Sachs, JP Morgan, all the big licensed mega banks that have an implicit support bailout at the cost of the Fed. So it's almost they're too big to fail, and they are shareholders of the Fed. So just square that circle of that corrupt system in your mind for a while. They've created so much debt that they are destroying the buying power of the fiat and the debt, and it takes turns in rate cycles to devalue each half. So as the rates go up, the debt valuations go down. Now, on that point, I've got to make a little turn by a key chart that we have. There is the TLT. This is when we called the top in an inverted HVF structure up here around the 166. We said that high was the last high. You're going to go substantially down. You got a shoulder. We reshorted at the neckline. This is a long-term debt ETF. You're in a rising wedge. You've broken through. You've had a return move, and you're near the low end again, likely to make lower lows. That is the devaluation of debt that has gone hand in hand. And I'm going to put a US 10-year in here. The yield that goes hand in hand with the US 10 years yield, which has, despite the Fed likely to cut shortly, a 95% certainty to cut, you have actually seen the 10-year yield go up, up. This is a daily chart, up 4, 5, 6, 7, 8, and it's coming to the top end of our wedge structure that we've drawn. Again, I think it will be resisted and come back down. I'm not expecting it to break just yet. I'm expecting a down move, and we called this localized high to be here when it was just crossing the 4%. We said you're probably going to get here and turn. We thought we were spot on there. You've had a return move already. And I think you'll still have to sell off again. So the sell-off from this top end means money is flowing back into the bond market for that yield to go down. When does that typically happen? Fear. There's a problem. Concerns. You can see when you topped out here, you did also still have some element of a return move. You sold off. You do just bounce all the way before you eventually got that one-way spill that led to here. And in fact, this was all around the August period in terms of the yen fear trade. You can see July there and September there, and you know that your August was sitting right there, the beginning of August. That's your yen trade knockout. A little bit of fear, money crowds into the relative safety that used to be considered risk-free of the debt markets. So what we actually are going through as a process, so it's not sometimes gold goes up and sometimes it doesn't, that it's entirely random. The period that Michael referenced was another period when debt needed to be devalued. Debt needed to be devalued, and it got too far because of the Vietnam War. What did Volcker do? He kept hiking rates. What did that do? It killed the economy. It killed retail and the consumer, but it did succeed in devaluing what was being paid contractually on those debt instruments. And they contracted all that borrowing they'd put into existence that they'd given to the military industrial complex to build phantoms and puff the magic dragon that could just dump lead into a jungle and all the bombs, etc. They dropped more munitions in Vietnam than they did for the entire period of World War II. So it was vast. What did he do? He continued to increase the interest rates that devalued the debt. Now, what's actually happening is we have a global system where everybody is over indebted. And unlike during the Vietnam War period, where America was a meaningful exporter and had a much lower debt to GDP, they have a much higher debt to GDP. They're already at the highest of all nations in terms of debt payments on their interest bill. So they are on extreme payment levels. Of all the countries in the world, yes, Japan, their rates are lower, although their debt percentage is higher, they're paying less interest. America is paying the highest interest. So they are paying that money to the banking cartel that was given for free the license to create your money. The legacy families. Owning that shares in that central bank sure can be profitable. You are paying it to them. Your tax money is doing that. They need more tax, they tell you, to be able to afford doing that. Hence why unrealized capital gains and all these ideas are being mooted, which means they want to take more from you to pay more to these people for the spending they did in wars that you didn't ask for. That's how it works. So as this is contracting, gold will be the alternative reserve asset. They completely definancialize gold. It used to be a 20% hold. Certain legacy families that I've addressed hold a third of their wealth in gold for preservation against the known inflationary policies of the central banking cartel that they themselves probably even control and instruct to do that. So they are taking the inoculation for the course of action that they are driving through other people, because you don't have the wisdom to know that you should be 33% in gold. The portfolio allocation used to be 10 and 20% long before the 60-40 portfolio. So you would have a 10 or 20% allocation for gold for the central banking cartel's known policy of inflation, which is taxation upon you, the dilution of your fiat money. Now, what tends to happen is once you've got so over indebted, the rate that this Jupiter planet needs to deflate by because of the printing you need to do to service that interest. So now you're printing and diluting to pay the interest on an already over-proliferated, over-indebted. You enter what is called a parabola. So you're going to see the buying power, the value and buying power of your fiat currency strangely just continue to dilute much faster than you've already witnessed. In short, prices are going to move on you super, super quick, and you're going to see parabolas in gold, silver, and the alternative system, which is also Bitcoin and the altcoin market, which will be your new digital financial prison of surveillance finance. That's the journey you're going. So every question as to why gold sometimes goes up when interest rates are going up, when they're flat, and when they're going down, and sometimes can go down in all those instances. It's when are you in terms of where are you and what is the state of play in terms of reserve asset. The bond market has served as a stable reserve asset for the last 40 years. I've never trusted it. I've never believed in it. But we definancialized gold. We pushed rates so high we diminished the debt. And then you had a 40-year bull market where it continued to creep up in appreciation, mildly, not like the stock market, but it lent stability and got a bigger performance return in the periods when equities crashed. So it became a binary system where scared money in the stock market ran into bonds. So what you lost in a crash situation in the equity markets on the occasions that happened, you made a little bit extra. Not 100%, but you got partially compensated in the bonds going up. Eventually the bonds continued to go up in value and the rates down, and that's how it has to be, that your yield that you were getting started to become near meaningless, and the bonds were very fully priced. The peak of that was the 0.3 in terms of the high I was showing you on the TLT, that what coincided with the extreme fear of shutting the whole world down. That's right, March 2020. You know what happened in there, and that was the blow-off lows in rates, which took you to about 0.3 on the 10-year, and the super valuation of debt. That was the end of debt as a reserve asset. Now we are in an environment where the only way is down, and what was the escalator up, we continue to repeat, is an elevator down. If you look at that rate of descent versus the rate of ascent. You can see on the TLT how long it's taken. And I don't know how far back the history goes. It's not got that much history. From 2003, you've essentially given back 17 years of growth to that peak high from 2000. It's actually 2002 that we start here to 2020, which was March. So 18 years of climbing. You've given 85% of it back in a quick 3-4 years. And it's going to get worse. It's going to get worse. The valuations of debt are going to continue down. Pension funds have too much of it. They're going to want out of it. What happens when everybody starts putting 1 or 2% Bitcoin and 20% of gold again in their portfolios is they are clearing out the debt. Who's going to be this buyer when the normal curve of Joe Normal realizes, of all the pension fund managers, the hedge fund managers, this peak wall of money that wants to exit bonds, all is going to go where? It's going to go somewhere which is perceived as a reserve asset. There is the legacy reserve asset, which is gold. This is why Donald Trump is in such a hurry. It's not him, it's his handlers and controllers that are being handled by the families, the nameless families of legacy wealth that go back to the City of London, Europe, the old families of Europe, etc. They are telling the handlers what to do. You need to try position an alternative reserve asset as well so that it isn't all going to the gold bugs. That is why you have Bitcoin and you have the Tether situation with the deflating of this particular Jupiter planet. My goodness, you'd think I was on the tequila this morning. Deflating back down and inflating. Their goal is more to inflate the digitized gold that Bitcoin has always tried to be. Therefore, it's tried to kill gold, which is why you have this antagonism of Peter Schiff and Michael Saylor trying to highlight why theirs is better, because Bitcoin wants to be gold, but just a better version. And that's why it isn't and wasn't always about getting your sovereignty. It was to take the flows that would go into gold over here. It was to take the flows into a different on-ramp. It was an on-ramp that was to position itself in between the escaping funds here that would normally be going into gold and to skive some of it off into them, eventually into a much greater degree. So they create pumpermentals, greed. People don't think about the system. They say, yay, we'll go for this. Coin go up much faster than on gold, etc., etc. Everyone will chase the money, not the principle, including us, because everybody is foolhardy. That said, we will take gold and we will hold gold because it's lower beta. And in these sell-offs on market crashes that Michael is going to refer to quite a lot, and I suggest watching the interview, it's a good one, is likely to see stock markets that are hopelessly overvalued. So I want to show you a couple of asset categories as well, and how the money works as well. So a different diagram over here. Eventually, we see the death, by the way, just to finish the last of those diagrams. Eventually, we see the death of the traditional system. We'll have a parallel running period in a very deflated state. The people that are the last to switch the lights out on the old system will have lost incredible buying power. If you want to maintain your buying power, you need to be in gold, silver, and I still suggest you should have something in the digital assets, even though it's a hold your nose trade, okay? Because it's your future digital prison. We aren't going to stop it. This is being done at a much higher level, but we should work at maintaining the physical system in what is being pushed into a digital world where physical assets on blockchain for all your properties and all your high value assets that you purchase, such as vehicles, even though they be depreciating assets and anything else, will end up tokenized so that they know all that you own of value and what your net worth is. And it will be searchable on a blockchain transnationally, no matter where you live in the world. So even the nomad capitalists amongst us like ourselves eventually can be investigated by various global tax authorities to see what we own and hold and what we've declared and not declared, etc., for max extraction. max extraction. So that is the end game. Let's have a look at those flows as well. The one missing here is kind of the stock market, and I'm going to insert it in here. But here is the crypto space that is going to expand. And as I say, note that Trump is the crypto king. It's the key theme. He wants a strategic reserve asset. He uses the phrase reserve asset. That is a phrase I have been using on our YouTube channel for an immense period, saying the bond market no longer serves as a reserve asset. It grows very slowly, gives a moderate yield most times, now probably below your true inflation rate in real terms. But it did serve as a parking bay for money that was a holding pen, which wouldn't supposedly lose money. And during that 40-year period, it did have moderate capital gains as the rates came down. Eventually, its yield disappeared to next to nothing. And then it had that huge correction that I showed you on the TLT, which is roughly 45-50%. You can't be that low in returns in terms of capital gains and that low on yields in an inflationary environment where the inflation rate is higher than that, and then have the volatility to the downside of a stock market where you lose 45-50%. On a risk-adjusted basis, what are the potential gains to the upside versus the downside? Bonds has blown its reputation. Why? It's the debt stupid. The proliferation of debt is too vast. I've got pink Krog containers on huge oil tankers piled to the roof with containers lined up out the harbor. My house is popping with them. I'm wearing a different pair each day. They're all transgender pink. I'm trying to sell them at flea market stalls. They're coming in at 100 times faster than I can sell them. Their value now is no longer good. Over proliferated. Everyone who wants a pair has a pair. There's no one who can sell. I can't give them away for 5 cents. Okay, so this is the debt market. Where is that money flowing? New reserve asset status is being sought for Bitcoin and crypto, which is why BlackRock said portfolios should also now include 1 or 2% of Bitcoin. They're starting small. Watch that number go up as debt market continues to underperform and go down. You've already had an Australian pension fund that's put 17 million into Bitcoin. Also, the original money moved first into gold, the king of the anti-fiats. Central bankers weren't buying Bitcoin. They bought gold. That's why Bitcoin broke out of its long continuation pattern before Bitcoin. Yep, that's a fact. And then you'll see eventually some trickle through into the other monetized precious metals such as XAG, and you may get a small element going into the super rare platinum and other collectors, but on a much lesser scale. Now, property. Let's deal with properties and stocks. So stocks is not here. I'll put it in here, and there's a chart for you of market only go up, 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 up. Hyper valued, overvalued stock market. The money that is fearing reserve asset status loss of bonds is not all going to run into hyper overvalued stocks. It wants a reserve asset, gold historical reserve assets, plus Trump is setting his lemonade stand on the road to the gold market saying, hey, we're calling Bitcoin a reserve asset. And America's going to buy Bitcoin as a reserve asset too. And we're going to pumpermentals it up to show how we have lots of reserve asset status now of high value. And Michael Saylor is, of course, helping doing that by running a Ponzi scheme, borrowing ever more money, buying more Bitcoin. As his stock goes higher, he can put more of it as collateral, borrow more, and continually increase his average point. He's now through 61,000 as his average entry point, by the way, while Bitcoin is at 103. A 50% fall from 103 will take him down to 51.5 and put him well underwater in terms of his entry. So that starts to be a very interesting situation. And he's bought more and large amounts and been able to buy more and large amounts as it goes up because it's a self-enforcing. Everybody's prepared to let him borrow more when he's winning. So that makes it blow up even more to the upside, allowing ever greater leverage for him. So that adds very suddenly and violently to his average cost. There was a time it was 30,000, now it's 61,000. Anyway, that's an interesting point. Here's Trump saying, but, continue on around the roundabout and go and get your reserve asset, your strategic reserve asset. That's why they're using this thing that's kind of a cross between the oil reserve and actually more of a financial reserve, because it's positioned as a gold substitute. Digital gold without that worry about custody. We'll do it for you. Here's Coinbase, cornered 90% of the market, signed all sorts of deals with the IRS for ensuring everybody pays their capital gains tax, etc., etc., etc. That's what you're getting. And the reserve asset status, why the question Kai asked is, well, what's happening with interest rates and why is gold going up or down or whatever on the interest rate environment? Gold continues to be strong and is strong and broke up strongly in an environment where the rates were going up, because the bond and debt value was being devalued and money was exiting the bond market and going into a new reserve asset, the original old of millennia assets, in truth, gold. And that is why they're in such a rush to establish an alternative to see people go in there. So some money goes out of bonds and pursues risk in a very highly valued US stock market, but they are aware that that could have a 40% correction. You actually had an 80% correction in the dot-com boom. If the Mag 7 had a even part correction to the tune of, say, 60%, that would drag a lot of indices down immensely. Some of the growth over the last few years is almost entirely attributable to the likes of Nvidia and the Mag 7. What happens in this ever-escalating interest rate environment where debt is being devalued, rates are going higher? Remember our seesaw that we haven't shown you of all our diagrams. That, by the way, is in our newsletter, which you get when you click the link below for the free mini course. And you will get all the diagrams we do trying to explain the situation. So you may even get some money come out of stocks and into gold for a safety play when things get scary. It's less likely that a whole bunch is going to run back into debt if it came out of debt in the original instance. So what you're going to have happen is there's going to be very few buyers of debt. Unless there's a situation of extreme fear, there will be some Pavlovian buyers of debt, but the debt markets have lost the confidence of everybody. You've heard the amount of people bleeding out about the underperformance of the 60-40 portfolios for 2 years in a row following the debt market collapse, and when the stock market sold off as well. In short, they both went down, and the reserve asset was not serving its purpose. It actually lost 45% over a 2-3 year period. But there can be a period where you get a little bit of a flow back into the likes of bonds and gilts and currency in the event of fear being big enough. The crypto market could crash and you could get a little bit of contraction. Now, gold on the yen carry trade lost 4.75%. Crypto lost 30% during that fear moment. So you'll get a bigger flow out of the higher beta back. But generally, the money flows are going like this. They are going out of the debt market, which means rates go up, which means property as a market is likely to be going down in value. It's going to be harder to raise debt because as an asset category for the bank, the debt is being devalued. The interest rates and cost of payments are going to be abnormally high, and people that are on already better deals won't be able to afford to sell because to buy again, they would have to engage at the new rate levels. So the liquidity will dry up. You will have people then eventually in employment situations where they've been dismissed, retrenched, or cut, not be able to sell their homes, and you will have an overhang and a re-rating in price, much like the subprime era, because of interest rates this time, killing the new buyers. In spite of it being very bad for the economy, the general economy. So it's going to be a hyper-stagflationary environment where in actual fact, rates are going to be stubbornly high, jobs are going to be cut, commercial property is absolutely a busted flush, that debt is going to be devaluing, written off, buildings are going to be given back to banks at a fraction of what they were originally worth or borrowed to in terms of that. There's a massive amount of New York real estate in the commercial property that is not let at the moment. It is an absolute disaster. So property, commercial particularly, but even residential, it's not the time to aim to be an Airbnb king on zero down deals. How many properties can you buy and let? Your consumer, your renter, your holiday maker is going to be reducing his activity. So your income will go down. And more importantly, the cost of serving those excessive mortgages with very little equity in them are going to escalate higher and higher. This is going to lead to a real estate bust that will drag also the stock market down. Eventually the Mag 7 will roll. There's a consumer element to Google. Amazon is still 51% reliant on the consumer. It's not all the military industrial complex and server deals. You'll find the consumer will start to be more and more wrecked, more job cuts, etc., etc. So stock markets can correct. You will get during that period a small amount of flow back into the debt market, but not to the degree of it's our safe haven anymore. So you will, in a contraction of the stock market and the property market, potentially get a short dip in the metals, a bigger percentage drop in crypto, and a little bit of flow back into bonds, but actually you're going to get some green money flowing into gold. That's why it will be short and it will go higher, because everybody will be preempting the eventual aspect that at some point printing will come again. And as a result of that, further devaluation, which is going to be undermining to the bond market. So whoever runs there in fear will quickly find that they'll need to get out again. And that will lead to precious metals outperforming immensely. That's how gold goes up in an interest rate environment going up, because it's about a cyclical debt devaluation after an epic 40-year proliferation of fiat and debt that led to inflation, first in assets, the original dot-com boom, then in property, the 2008 boom, which have all, despite crashes, re-inflated again, and then eventually into commodity costs, which are things that are the last to move. By the time you feel it in your bread, your milk, things that are industrial farming scale, where there's been a lot of technology, an incredible amount of massive tracts of land run by 4 or 5 people with very complex equipment that certainly moved on immensely in the last 50 years since we were in the 80s. You know that it is fiat proliferation, debt issuance, overspending. It's the debt stupid, and it's the collapsing of the debt markets valuations that are going to lead to interest rate spikes, and gold will go up. As a substitute reserve asset, it was the original reserve asset, as the 40-year period where debt could serve as an asset, and we used up all the life when we ran the rates down from the high that Volcker gave us. That was true real yields by the time he finished and actually exceeded the inflation, and you actually were getting some income, and they appreciated and the yield dropped until they were at peak valuation in 2020 after an extra normal event that closed down the economy, was super brutal to stocks, was brutal to gold for a short spell, but it shrugged it off and quickly went higher. And was brutal also to cryptos in March 2020, as you'll know. But post that, as everything is reflated, gold will be the reserve asset of choice. To only be in crypto is to be foolish. To only be in gold is to miss out on an opportunity of a very high beta market that could deliver abnormal returns with a lot of volatility. That's where you need to think. To be over allocated in property, and especially which is financially geared, it's okay if you own your property outright or you have an incredibly low mortgage on a fixed deal. I do think banks will eventually try to wiggle out of their fixed deals if their contract clauses allow them in some form of force majeure. So any debt is bad, but generally you should be safe at least for a while if you have small mortgages on your properties and fixed deal rates. However, not forever. So I have no relationships with banks on real estate, and I'm happy about that. This is not the time for the Robert Kiyosaki model. That was the time during the 40-year period we discussed post-Forker, where you took as much debt as you could. It was banks' money, and you were going to get an asset price inflation due to proliferation a la the Greenspan Goldilocks, who kept interest rates artificially low because we had an outsourcing of all production going global. That is now being reversed. You are having the night to that day of absolute Goldilocks, and as a result, contraction on property asset prices, commercial first and more extreme. Eventually, resi will be affected too. I would take whatever I could get. If I was sitting an Airbnb landlord with big mortgages on all of them, I would be selling and only keeping that what's left once they are all 100 paid. If that means I go from 10 properties down to 2, that's exactly what I do. Unencumbered properties, that will be the difference. By the way, rentals will go down probably in real terms, quite possibly in nominal terms too. If the consumer is going to get crushed, the likelihood of that is exceedingly high. Okay, so that's why gold can go up. It's not random, and it has done it in that period, and it can do it, and it's done it once before. It's specific criteria. People lost confidence in debt. The French called for the gold. The Europeans called for the gold. They didn't want the paper. Remember that. Faith was lost in the paper. Right now, you are living in faith being lost in the paper, fiat, and debt system. That's why they are trying to give you a digital gold alternative at the same time, because they know the likes of Paul Tudor Jones, Druckenmiller, we are short debt, long commodities, long gold, and long Bitcoin. Okay, you should have all potentially, and long commodities. Let's take a short sidebar from that and handle the long commodities part in part 2 video to this one. And you will see that video released later, where we will look specifically at commodities apart from gold and silver. I'm talking softs and agris, and why and which one we see as a major mover, and why we agree with Paul Tudor Jones, or should I say he has eventually come to our part of the world and agreed with us, having stated this 4 years ago. That the debt markets are in terminal decline and reversal, and that all forms of assets are going to go up in a very aggressive manner, and you're going to find that your dollar in hand, your euro in hand, your pound in hand is facing a much faster escalation of prices, and you won't know why. It's the debt market contraction, which is the loss of the buying power of that fiat. And it won't be a great economy. It won't be a boom town, but your buying power is going to just out of the blue feel like it's just slipping, and prices are changing on ever shorter time frames. You think, well, I've experienced that already. You're going to experience that on a more extreme level. That's why not participating in the gold and crypto markets will see you be impoverished. The 2017 video we did from the top of the polarization of everybody's wealth is coming, will be determined by those that saw and understood this and got aggressively, and forget the 5% of this world and the 1 and 2% participation. If you are staying in an overpriced property, an overpriced stock market with a bond portfolio, and you're putting 0.5% here and 0.5% there, you are not going to insulate yourself from the events that are coming. You need to aggressively position in the anti-fiat bond collapse alternatives, reserve assets, that they want to be the reserve asset because they will make it work and chase the greed genie and have everybody pumpermentals, but not solely, with a massive holding, a seismic outproportion holding in the millennial standard of reserve asset, gold and silver, and light on property leverage. Wealth taxes will also play a role. I hope you enjoyed this, and I hope you look forward to our commodities update that we will be doing that'll involve other markets apart from gold, which we feel will be climbing. Till next time, talk to you later.
Tired of profit wipeouts and blown accounts from following trade signal groups and other YouTube channels? Looking for a better way to trade, reduce your stress, and minimize your risk? Become a skilled technical analyst and see the charts and markets in a new light using the successfully proven HVF method by Francis Hunt, while being surrounded and supported by a principled, structured, and experienced community. Enjoy a constructive learning environment while practically trading markets, supported by a bespoke platform run through browser and app, specifically designed to teach and engage you whilst learning and growing as the markets move. This is not a Telegram or Slack signal group. All trade ideas are based on a proprietary technical analysis process honed over decades, which is the HVF method, leading to trade ideas with fast-moving breakouts and tight stops, exact entries and exits, nuanced interim considerations, and ultimately, strong rewards. Submissions are graded and scored by Francis for potential high-quality setups, and we provide bespoke tools to help get the job done properly and with precision. Over time and with focused effort, you'll begin to look at charts and price action just like Francis. Community updates every day by Francis and our 3 webinars a week provide a 360-degree approach, which are presented by our experienced team of trade leaders to spot potential trades. We're a community of self-actualized individuals, spanning the globe and active 24/7, 365. The premium community provides a warm, supportive, and cooperative place for people willing to listen, participate, contribute, and to learn. We've changed thousands of traders' lives. Transform your approach to trading now. Transform your life. Book an introductory call with us on the link below.